You're listening to the Moneyweb Now podcast series with Simon Brown. Live streamed every weekday at 6:30 a.m.
Wednesday, 22 July. We've got alphabet results after US close late tonight. I'm Simon Brown, coming at you live and loud from the Moneyweb Global Headquarters in Johannesburg, South Africa. On the show today, Zimele Mbanjwa from FNB Wealth Investments. The Sasol Business Performance Metric Update for the full year. I got to say, it looked really good. I mean, I don't know, is the stock all about oil and war these days, or do these numbers really matter? We chat with Benay Sager. He is from DebtBusters, their latest money stress tracker for 2026. This is now the fifth year that they've done that report. And then Tertia Jacobs from Investec. We have local inflation due in a couple of hours. And then, of course, we have an MPC rate decision tomorrow afternoon. This podcast is brought to you by Stanlib Asset Management. Invest in more global opportunities through their partnership with JP Morgan Asset Management. Morning headlines, Moneyweb, what a spa built on convenience is no longer convenient. Every single 60/60 order by a spa shopper chips away at that retailer's foundation. Business day, PIC crisis deepens as 6 directors join board exodus in a week. Morning markets, the US was green, S&P 0.9% higher, Nasdaq up 1.9%. Over in the east, it is mixed. We've got Sydney up almost 0.33%, Tokyo almost 2% higher, Hong Kong is off 0.8%, Tencent down 5.3%. Commodities, all green. Gold futures, 4,139. Brent, 92.08. Platinum, 1,675. Palladium, 1,324. The Rand is 16.45. Bitcoin is 66,200. And top 40 opening call, red open, 95 points or 0.09% lower.
Moneyweb Now, on the money. Also available on podcast.
Chatting now with Zimele Mbanjwa from FNB Wealth and Investments. Zimele, appreciate the time. As I said, the Sasol business performance metrics for the year ending 30 June. Bit of a mouthful for what it was. But your thoughts on it? I mean, to me, I thought there was a lot of really good numbers coming out of Sasol.
Yeah, morning. Thank you for having me. Yes, certainly I agree with you on that one. It was pretty positive. A lot of good is starting to come through, and I think just reading the report from yesterday in conjunction with the capital markets they addressed last year, you can see that their targets, that they had set out from an operational standpoint, improving reliability, ramping up the secondary operations and the likes, improving volumes through technical interventions, improving coal quality. All of that is starting to come through, and it's adding to the positive read that we got from the report yesterday. Strong cost management, strong production across the board for the most part. The chemicals businesses are actually doing better than expected. They're expecting adjusted EBITDA there to exceed their targets that they set for the year. But I think just importantly for me, just the operational improvement, which is something that they can control, the cost discipline, the capital management they spoke about, further lowering the capital expenditures, which was a major target that they set for themselves as far as just managing their books and where they allocate capital. So, I mean, I think, despite some external pressures, it was a pretty good report to read.
It was, because I think at the moment, I mean, we all just think Sasol and we think, we're following the oil price and whatever's happening in the conflict in Iran. And to be fair, I think Sasol probably is. But what this report tells us is that once we sort of see some normalization in Iran and the oil price going back to normal fundamentals, there's actually a markedly improving business under the hood at Sasol.
Absolutely. The conflicts, the higher oil prices, they definitely take that, and I think it's definitely helping from a short-term perspective. In fact, I was looking at that Capital Markets Day report from last year, and their nominal break-even oil price was around $50 per barrel. So, I mean, if you compare with what we've been averaging over the last year or two, it's much ahead. So it's definitely helping them. But obviously, I think as far as self-help initiatives, I think that's what they call it, they've definitely been playing their part, and it is an improving business. As I said, the international chemicals business, I think they gave a financial number there from a guidance perspective yesterday. They shifted that from a volume-driven to a value-driven approach last year, and that again is paying dividends. Under the hood, the business is certainly improving. And once the volatility perhaps slows down, I think it'll be more evident to the market that the business is is very much different from what it was, say, 2 years ago. Despite the oil price volatilities, plus their hedging program is very, very robust. They try and manage it quite well as far as the volatility and participating in the upside of the oil prices.
Yeah,
and the chemicals prices.
Yeah, absolutely. It's a great point. And they are, I mean, as they said in their statement, and as you said as well, what they are doing is they're managing what they can manage, and they're managing that incredibly well. And that perhaps is the key point. Oil price, yep, they'll take it, both hands. But that's beyond their control. Chemicals as well. Leave it there. That's Zimele Mbanjwa, FNB Wealth and Investments. Appreciate the early morning time. The Standard Flexible Income Fund is designed for pre- and post-retirement income and capital preservation needs. Retire without regret with Stanlib Asset Management.
Moneyweb now on the money.
Chatting now with Benay Sager. He's executive head of DebtBusters. The latest money stress tracker is out. This for 2026. Benay, always appreciate the time. Fifth year of doing this, which means we're getting some really chunky sort of historic data as well. And I have to say, for me, the jump out was that cost of living has dethroned interest rates as the stress, the anxiety. I suppose it makes sense. Rates are down, although we did have an increase just the other 2 months ago. But cost of living is the big stress point these days.
Yeah, exactly. And I think these are the consistent themes. And I think when you look at the 5-year horizon of what we've been asking people the questions, I think just on the back point, when you combine inflation and electricity concerns, last year 24% were worried. Now 37% of people are worried. That's a significant jump. I think from debt repayment perspective, it's always been number one or number two. Running out of money, of course, is the fear. I think that's humanity's fear for the last thousands of years. Nothing has changed from there. But the struggle to pay the debt at the end of the month, that's definitely also jumped. So we don't like seeing that, even though this is our survey and our primary business, as you know, is debt counseling. We would like to see these stress levels go down. I think I want to just point out, particularly for younger people, this is where we saw it's become more of a chronic problem. And I think the thing that worries me the most is under 25s reporting that they are really struggling, when it comes to being financially anxious. There was a significant hike in terms of the financial concern of any age group. I think with an 18% increase in this group when they're reporting stress. And I think the challenge you and I and everyone else faces with this is that they've got another 40 plus years of work time. And if our young people are going in anxious about their finances already, albeit that there's obviously the contributors of where the job market is, contributors when it comes to AI is going to eat into jobs. All of those things are true and they're real and they're experienced. But our challenge is actually trying to get people back into a more of a psychological state where they actually feel that there is an optimism and they are going to get to someplace in the next 10, 20 years.
Yeah, that's a great point. It was young people stress, and then women carrying more of it. Women rate higher on nearly every financial concern, aside from retirement, and their home life stress at 5-year highs. And we did see that. I mean, it was another thing that really did stand out. Home life is where we're seeing it sort of showing up more than increasing quite markedly over the last year.
Yeah, exactly. And I think this is also particularly challenging. And that is the highest number we recorded in the 5 years. And, home is meant to be where it's a bit of a sanctuary for all of us. I'm not saying homes are perfect, but it's meant to be physically and psychologically safer place where you can recharge, rebuild, rethink. And I think if less and less people are feeling that is the case, and in other words, more and more people are reporting home life stress, that's a problem, I think, for the sustainability of where we are. And I think particularly coming from women, because they carry so much of the burden of, running households, looking after children, often being primary caretakers and so on. I think those are worrying signs for us.
Some good news coming from this. I'm always going to find the good news story as well. Fewer people embarrassed to ask for help, and negative sentiment around debt counselling fallen 23% over 3 years. Those are, to my mind, two very, very important metrics, and particularly for where you sit. But for the ability for someone to say, you know what, I can't do this, I need some assistance, and being able to be comfortable with that is huge.
Yeah, absolutely. I think the one about not being embarrassed to ask for help, that was really, really exciting for us to see. And that went down from 23% to 12% of the people. And I think what I always urge people is, you don't have to talk to me about your finances, but you have to talk to the people who are closest to you. Yeah. Those are generally the people who would have the best ideas in helping you, but they can't help you if they don't know that there's a problem. And I think, the world is full of many examples where the stress is kind of bottled up. And unfortunately, as you know, we lost one of our Bafana players recently. It's a similar story. It's basically psychology eating into one and not really being able to, or feeling like you can talk to. So I think we have to talk to people that are closest to us. You will be surprised that they're actually going to be like, you know what, we're in this together. We're going to make a plan. I'm always surprised when that happens. And I think we shouldn't be so surprised, because people that are near us and dearest to us are always going to try to help us. And I would urge everyone to start talking to them about their own finances. It's the only way out.
Yeah, agreed 100%. We need to talk more, and in many cases, as you say, what we think is insurmountable. There often are actually solutions out there. We leave it there. Benay Sager, Executive Head, DebtBusters. Appreciate the early morning time. Let your money benefit from experience with Stanlib Asset Management. Find out about Stanlib Global Select Fund, which follows an investment discipline that has delivered results for 3 decades.
Moneyweb now on the money.
Chatting now with Tertia Jacobs. She is Treasury Economist and Fixed Income Specialist at Investec. Tertia, 2 big data points. Inflation today, MPC tomorrow. Let's start with that inflation for June. What are you expecting? We got a slightly better than expected number last time. Can we be pleasantly surprised again this morning as the data comes out?
Hello, Simon. Yes. So, well, if we look at what you're saying, a better number, it's widely anticipated that the June's inflation number will be higher, right? Mm-hmm. So May's number was 4.5. Currently, we're looking at about 4.7%. I think what's going to be quite important in this number is the core CPI inflation, because it's now like 3 months into the war. Mm-hmm. Yes, we had some petrol price cuts, but we're going to see if there's any, pass through from the higher fuel price into core goods.
And that is, my sense, the real concern. We get the fuel price. That is going to be dependent on oil and exchange rate, and not a lot we can do it. But it is that pass-through, that second round effect that perhaps is the big concern that we need to keep an eye for.
Yes, I agree with you.
In terms of MPC tomorrow, they're obviously going to get this data. They meet today, they meet tomorrow. The announcement will be 3 o'clock with the governor and his team. What's your expectation there, or is it really a lot riding on what the number is we see later this morning?
So that's a very important question, because we have seen in the past, for example, where the inflation rate is sometimes published the day before the MPC meeting. And then it comes out a little bit better, but the MPC still goes ahead and hike, right? Mm-hmm. I think the thing is the decision is not shaped on the most latest data. Yeah. They have their forecast with their assumptions, and that is what influences the decision. So, for example, the May's inflation rate that came out lower, while that is also important, it lowers the trajectory of inflation going forward. So I think that will help to lower the near-term inflation forecast of the Reserve Bank. Yes, what we can add perhaps is that, when you compare the landscape that's driving inflation, from as early as last week, it has definitely changed again. So what we will also be wondering is, to what extent the Reserve Bank has already been more cautious going into this meeting, because, our view was that the Reserve Bank could hold because the level of real interest rates are relatively high, right? We're not starting from a low point. We expect them to lower the near-term inflation forecast. The fiscal position looks very good, so that must count for something. Yes, inflation expectations ticked up, but, 2-year inflation expectations are below 4%. So how will the Reserve Bank weigh these things? So it's certainly going to be a very interesting meeting tomorrow.
They voted 4-2 last time in favour of the increase, 2 voting in favour of no change. So we're kind of close. We just need a small tweak there to get it to the no change. Are they looking at? We've been hearing lots of talk around drought effects potentially coming later in the year. Is that something which they would have on their radar as a concern down the line, potentially impacting into food, or is that simply too unknown and too far into the future?
I think the way the Reserve Bank looks at it, it is too soon, but it's certainly on the radar. So it will feature on the balance of risk assessment. So that will feed into future rates decisions. And I think our expectation is, that's going to have a bigger impact on food price inflation in the middle of next year. So we don't expect it as soon as this year.
Gotcha. Because, of course, there's that lag effect in terms of food planting until it finally gets to our table. A quick last question. I mean, the irony is that a 4.5 or even a 4.7 inflation print just a year ago would have been bang smack in the middle of our target range of 3 to 6%. Have we shot ourselves in the foot by changing the target to 3% with 1% either way? And to be clear, I was in favour of it. I thought it was a good idea, but we're now kind of paying the price for that.
We get those questions quite often. I think when you look back, how the stars have aligned to get inflation to 3%, it was actually, all the drivers that are now pushing inflation higher that were quite low. It was a low oil price. It was a very robust rand, although we can add that's also a constructive factor that the rand is relatively low. FX volatility is quite low. So all of those dynamics have changed now. So I think it's a very difficult question. It is what it is. We're not going to go back to 4.5%. But the question is, how will the Reserve Bank then play it? And I think this is where we're looking at an environment where interest rates can perhaps stay higher for longer. And very importantly is then how anchored is inflation expectations. So that basically means, that the MPC will continue to sound very hawkish. They will try and influence expectations, so that in a way it could become more self-fulfilling. The problem is that sometimes, inflation expectations are shaped by where the current inflation rate is.
Gotcha. And it is. I mean, we keep coming back to, in our chat with guests, inflation expectations is the big one. We'll leave that there. Appreciate the early morning time. Tertia Jacobs, she is Treasury Economist and Fixed Income Specialist, Investec. And our poll today on LinkedIn is, what do you think MPC is going to do tomorrow? Have your vote, have your say, LinkedIn. That's it for today. We're chatting with Benay Sager yesterday from FNB Wealth Investments. Their 2026 Retirement Insight Survey, 73% of South Africans under 60 have a retirement plan. That's a big number. We asked you if you have a retirement plan. Half said yes, looking good. Almost a third said yes, but a poor plan. The rest was split between not yet or you are already retired. Have your vote, have your say, LinkedIn. This podcast is brought to you by Stanlib Asset Management. Invest in more certainty to navigate volatile market conditions. We're live every weekday morning, the Moneyweb website and the app, 6:30 a.m. podcast just after 7. Thanks to my team, Eddie, Nobukhle, Nicole, Sabut, to you for listening, my guests for their time. My name is Simon Brown. This is Moneyweb Now. We'll chat again tomorrow. Tokenization.
You've been listening to another Moneyweb Now podcast, posted every weekday at 7 a.m. on moneyweb.co.za. Moneyweb Now, on the money.